Hello, it's time to take a look at Microsoft, a company which has about $2 trillion in terms of its market cap. And it is down slightly compared to the rest of the market, that is, about 27% since its 1 year high. And it's obviously a company that I would love to hold. It's not in my portfolio yet. I've been waiting for an opportunity, basically a cheaper price. Now, this has been going down and it may potentially give us a little bit of a cheaper price. It has actually already, 27%, but is it enough to actually get it for a long-term hold? Obviously, this is a fantastic company, and if you take a look at the 5 year chart, you can kind of see it here. It's been doing amazingly well. And every portfolio should potentially be wanting to add this to one of its holdings. And as you'll see here, this is a company that has been pretty much almost parabolic here through the years. Now, again, at this current slump, maybe it's an interesting opportunity. So let's take a little bit of a look at the financials of the company and see whether this is now the time to be adding this to a portfolio. Now, if you take a look at the P ratio and price to free cash flow, they are getting better and quite significantly better from what they used to be. You will kind of see that here, that this keeps going down. And the same thing with the price to free cash flow ratio. Now, this may be a red here because the software will make it a green when it's near 20 or so, 20 and below. But even though it is a red, the point and the most important thing here is whether it is a buy overall. It is an overall buy. And the way to examine that, it's not just the P ratio and the price to free cash flow ratio, though, even at 26 and 29, it may be slightly appetizing. Again, remember, you will very unlikely get this kind of great companies with amazing margins, amazing cash flow and everything at a very, very low valuation. So it may be worthwhile paying a little bit more for them. Now, how much more or whether it's worthwhile, we're going to be examining in this video, of course. Doing our usual analysis in which we're going to examine the company's financials, cash flow, and all the other metrics, the important things here. Outstanding shares that go down, meaning that the company is buying back some, but not too much. In terms of total abilities to free cash flow, over here you will see that this is rather low as well. Pretty nice, because it means that the company is actually having enough free cash flow. It's pretty solvent, pretty much, to pay back every debt that they possibly have, including potential money that they need to be paying to suppliers and things of that sort. And revenue growth that is about 80% is absolutely amazing as well. It has been growing tremendously nice, and this is something that you love to see, this kind of chart here. The company is increasing its revenue, same with the net income growth, even at a higher pace, much higher pace. Free cash flow growth at 102% over here, and total equity growth that has also been increasing, even though the company has been buying back shares, which means that they actually increase their total equity growth, not from issuing shares and making money out of these shares, but basically from their operations, which is amazing to see as a stockholder here. Now, you may be wondering, will this kind of growth continue? And I get the concern. It's almost impossible for a company to keep growing at this kind of level for the next 5 years or so. But the thing is, this is a company that has multiple levels in terms of how good it is. And it has to do, for example, with the margins that they are generating. They are generating amazing margins that keep increasing as well through the years. They have no debt, practically speaking. And take a look at this debt to equity ratio. It's going down and down and down. It actually may make a little bit of sense to get some, although this kind of environment with interest rates may not be a good idea. Overall, it's generally speaking a useful idea to have some debt, because they can help you leverage your operations and make more money, especially if you are super solvent and you are already making tons of free cash flow. The return on equity of the company is sitting at 45% as well, with equity increasing, which is rather nice because it means that the return is also increasing at a very, very healthy pace here. So great looking things here for a company which some could consider potentially being overpriced because of the PE and the price of free cash flow. But is that the case? We'll see. But first things first, let's take a look at the income statement just to see an amazing story of growth from 110 billion to near 200 billion. This is absolutely insane. The company has been doubling their revenue in 5 years, if not less than 5 years, frankly. And in terms of the net income, 16 to 72 is insane. I mean, you can get that. This is like 5 times more net income than 5 years ago. So absolutely amazing. In terms of the balance sheet of the company, you will notice that they have about what was it, 200 billion total liabilities. But remember, this was an about three times free cash flow from last year. So it means that the free cash flow will be about 60 to 65, maybe 70 billion. We'll see when we take a look at it. But the total equity at about 166.5 billion over here. Again, increasing very nicely through the years without additional paid-in capital, without the company issuing more stock. Now, cash flow over here, you will see that 89 billion was the net cash from operating activities, and it resulted in 65 billion free cash flow over here, with the company having about 14 billion in cash reserves. And they're spending about 18 billion, I forgot to mention that, in dividends, because the company does pay dividends, and we can always use the tool in our module over here just to see how dividends are increasing through the year for this company. Again, remember, you can gain access to our tool here by visiting this URL or by getting access to our Patreon page, becoming a Patreon. You can find the links in the description box below this video if if you don't want to type. Okay, so the next thing that I kind of want to take a little bit of a look at is the insider trades and the senator trades, because that's worthwhile. And you can see here that there haven't been any purchases really from insiders, but the thing that we really need to be taking a look at is what the chief financial officer is doing, for example. Generally speaking, the officers, but the chief financial officers, how much they are actually transacting here makes a ton of important sense. Are they actually selling a lot here? So you will see overall, and we can actually take a look at the chief financial officer, which is the most important person, obviously being related to finances. You will see how many securities they are transacting compared to how many they own over here. And so that's important, because you don't want to be seeing them selling out of all of their securities, like in total. They could be they could be actually selling some, which makes a ton of sense, because this is actually part of their compensation, and you do want them to sell some. It's normal. I mean, it's very normal for somebody. It's part of their compensation, but you don't want them to sell out of all their stock. This is, generally speaking, not great for for an investor to be seeing the CFO of the company like selling every stock that they have. It doesn't happen here, nowhere near that. They seem to be holding quite some still. No buys at all. However, nobody's actually buying extra with their money. But senators are actually buying some Microsoft here, and not worth noting that Nancy Pelosi actually also bought quite some over here, with their published date at June 3rd. Like a couple of months ago. She bought a lot, a pretty big lot here. Now, with these kinds of trades, we never know the exact amount unless they mention it at some point. But the filing is mentioning a range, and these are the ranges here. Pretty large ranges over here. She bought more from 2021. Actually, she keeps adding. Very interesting. Among others as well, like Josh Gottheimer here, also adding a lot, selling at times as well, but also adding some lately. Okay, so the next thing that we're going to be examining, and the final thing for the video, is basically our stock evaluation tool. Just see how much it makes sense to be paying for this company that is growing at about 17% in the last 5 years. Now, on average, that is. And you will see that this is pretty much what they are doing almost on every average over here. And so I'm going to go lower, of course, because we want to be going more conservative, lower than the averages, which will happen also at some point. The company cannot continue growing at 18% or 17% rate, especially as it's increasing its revenues at such high levels. In terms of the net income margins, they are also increasing, and they are increasing tremendously. So for this company, it does make a lot of sense to be using something like 28, 30, and 32 here. Free cash flow margins, again, 90, 100, something of that sort. So 90, 100, and actually, I should probably go maybe 95 here. I think it makes a little bit more sense based on the averages I'm seeing, and you kind of have to exclude these odd years, which they are affecting the average, but you will see that this is like 97, 102, 91, 90, so it's about 90 to 100. This way I'm using these free cash flow margins, and in terms of annual returns, 13% is what I'm gonna be using, my typical one, of course. I hit calculate, and you'll see that we are still in the red zone, so we would like to get Microsoft at a cheaper price. Now, remember, my revenue growth numbers are not like super aggressive, but they are not too conservative either, I would say. Now, if somebody was had more conviction and wanted to go something like 13, 15 and 17, with 17 again being the average, then if you hit calculate, you are looking at still a red pretty much evaluation here, but closer to the current price. And 17% I'd say is rather aggressive. It may be, and it's I think possible for the company to grow less in the upcoming years. Again, it's a huge company. It's not like the company itself is not good, but it's a huge company that cannot keep growing at insane rates. And this is why I think this one is still not a buy yet, and I would probably revert to my previous levels. 8, 10, and 12 is what I think makes the most sense here. And I would be willing to potentially get this company with even my high valuations here, if I was feeling nice that day. But it would be a little bit expensive, yes. But again, remember that this is a fantastic company in all fronts. So if I could get it maybe near between actually these two ranges, maybe 160, 170, that would be pretty nice here, and I would be looking to add some to my portfolio. But thank you for watching the video. Remember to like, that helps a ton, guys, and subscribe if you're not a subscriber already, and I'll see you in the very next video. Bye bye for now. See you soon.